Hi, welcome to Minute Mondays with MDR. I'm Kevin Clark. Today I'm here with JLong from Waterstone Mortgage, and we're going to talk about some misconceptions, right?
Yep, talk a little bit about the home buying process and things that people need to know.
Okay, great. Let's start off first with buyer wants to go out, look at homes. What's the first thing they should do? And let's talk a little bit about some misconceptions between those.
Yeah, so I guess I can't overstate the importance of getting a true pre-approval, okay? Because when you go out and you look for properties, you want to know what you qualify for. You don't want to look for things that you can't buy. You want to know that you can actually close on the house once you fall in love with it. And you need to know how much money is going to come out of your pocket. And so unless you've been to a lender and gotten a true pre-approval, you don't know what loan program you're going to use, and then you don't know those parameters. So I think sitting down with a lender and getting a true pre-approval, which is where your income's been reviewed and your assets have been looked at, and they figured out the best loan for you, is the first stop. Because then when you go out and find them the house that they're going to love,
Right.
they know that they can comfortably close on it.
Right.
Yeah.
That's great. And what's one of the misconceptions is the difference between a pre-approval and a pre-qual.
Pre-qualification.
What are the difference of those two?
Yeah, so historically, lenders would, pull somebody's credit and listen to how much money they made and say, okay, yeah, based on that amount of money, you should qualify for this amount of house, okay? But there are all sorts of different nuances, right? Sometimes there's other income. Sometimes there are things that have to be counted against people's income. And until a lender has really dug down and looked at that information, you don't know for sure you're going to qualify for something. And in cases where you don't have a true pre-approval, that can lead to some disappointments. So
Right.
loans getting denied down the road, things like that, et cetera. And so a pre-approval is where a lender has looked at all of those things and said, yeah, we've reviewed it, this is golden.
As long as you don't go out and buy a boat in between pre-approval and closing.
Please don't buy a boat, please don't quit your job, just wait until we're done.
Yeah. And so, all right, they get a pre-approval, and one of the other misconceptions is I hear from my buyers or sellers as I'm talking to them is, yeah, I'm not ready, I don't have 20% down.
Yeah.
What do they need down, like, in order to qualify for a loan?
Yeah, and so that's really situation specific, but there's not a single loan program that we offer that has a requirement of a 20% down payment or even a 680 credit score. Some of them do, but most people are surprised to find out that they can put as little as 3 and sometimes 0% down on a purchase, and they can do that without having a perfect credit score. Okay, so it really depends on the individual situation, but for most people, if they have decent credit and they have a job, if there's a will, there's a way to make it happen.
Okay.
Yeah.
Awesome. What would be that like limit on the credit score? Like, where do they need to be, and if they're under, tell us a little bit about what they could do.
Yeah, so there are places where it's really easy, kind of 680 or higher, places where it's still possible, which are 600 and higher, but it can require a little bit more work. And then once we're under 600, generally we're going to look at the credit profile and say, okay, where are you in life? Are you on the way up or are you on the way down? And can we get you a few more points with a little bit of credit counseling? Can we work with you on your budgeting and your credit to get you to where you need to be to qualify as soon as possible? So I guess kind of 600 is really kind of the minimum for where it starts to get a little bit easier.
Okay, good. What do you say would be another myth that people have when it comes to getting a home loan?
Well, I think a lot of times people are afraid to have their credit pulled, okay? Historically, lenders have told people that they can have their credit pulled X number of times and then it's going to start dinging their credit score. Mm-hmm. And although the credit bureaus won't release the exact algorithms, people that are kind of in the know have told us that what they've gone to is allowing a shopping period, okay? So they're aware that when people buy goods, they shop, and their credit bureaus generally aren't penalizing people for having their credit pulled by a few people in a short period of time. So if you're having your credit pulled constantly, okay, that can be an issue. If you're doing it over and over and over again, that can be an issue. But if you're having your credit pulled by 1, 2, maybe even 3 lenders, we don't generally see that dropping people's credit scores,
okay,
because the credit bureaus consider that smart shopping.
Good.
Yeah.
Yeah, that's good news. Now, one of the ones that we're up against right now is where the interest rates are heading.
Sure.
and most people are saying that they're rising. And you agree with that?
Yeah, I would say that since late last year, we've seen about kind of a 0.5% increase on average in interest rates in the market.
Okay. So, a myth would be too that some people are going to just wait. And so let's say that the rates are at 4.5 today.
Okay.
And they waited until spring next year. And all of a sudden it's a 0.5 point higher.
Mm-hmm. Yeah.
What does that do for them?
Yeah, so on a $200,000 house, if the interest rates go up about 0.5%, that means that for the exact same payment, they qualify for about $10,000 to $11,000 less house. So they're then in a place where they have to make a choice, right? Do I buy the same house and spend more money per month, assuming they qualify?
Right.
Or do I shop for a smaller house? And that's the cost of waiting, and that's assuming the house doesn't go up in value from one year to the next. And what we've seen over the last couple of years is pretty strong appreciation. So once you throw in a little appreciation, that cost of waiting can be real. You could hit $100 a month in difference, and that makes to most families, I think, a big difference.
Yeah. Definitely. Give us a plug here for Waterstone, some of the products that you offer that maybe others don't.
Okay, so Waterstone's kind of a one-stop shop. So we consider ourselves the power of a mortgage banker with the flexibility of a mortgage broker. Okay, so we can sell our loans to Fannie or Freddie. We offer conventional loans and FHA and VA loans, but we also have a portfolio. And then we have some unique programs like the loans that we have for people that might have a lot of assets but not a lot of monthly income to qualify them for a loan. And we also have some pretty strong physicians programs. Okay, we also pride ourselves on being communicators and educators. We think that that's very important, and it's something that differentiates us from the rest of our competition.
Awesome. Thanks so much for taking the time
pleasure.
to be with us today, and join us every week on Minute Mondays. You can like this, you can share it, you can go to our YouTube page and subscribe. We hope you do all three. Yo, welcome to Double M with MDR, and I'm K-Dog, this is JLong. We're here to talk about financing.